Are we heading toward housing crisis 2.0 this year in 2022? What is happening to rent and housing prices? And what is also happening at the Fed this week that you should know about? Answers to these questions coming up, along with a side of chips and salsa as we kick off my favorite weekly holiday. Hello and welcome to the Taco Tuesday edition of Ask the Lender. If you are Taco Loco like me, do me a favor and subscribe to my channel and smash that bell right there to get notified. Make sure to comment below with your thoughts on where the market is headed. Two things are for certain. There is a massive housing bubble and the Fed is holding the pen. The bubble in the housing market today is bigger than it was before 2008. And there is a bubble for the same reason. The central bank has held interest rates artificially low for nearly 2 years. And on top of that, it has stuck its big fat thumb on the mortgage market with its purchase of mortgage-backed securities. With those loans off their books, banks could lend more. So make sure to stick around until the end where I reveal why rising interest rates may be the pin that pops this bubble. Full disclaimer here, I am not a financial advisor. I do not play one on TV, and I did not stay in a Holiday Inn Express last night. I'm just a hardworking dad who helps raise awareness on what is happening in the housing and stock markets, provide tips to reduce debt and improve credit. Plus, I help individuals and families qualify for a home mortgage. So if you or someone you know are looking to purchase, sell, or even refinance a home, make sure to hit me up. The result of the Fed's policy and actions is the skyrocketing home prices we are currently seeing. Is it sustainable? Well, they keep increasing, but stick around a little bit more because interest rates are a key factor, and more on that in just a second. In the same way quantitative easing creates artificial demand for treasuries, thereby keeping rates low and facilitating more government borrowing and spending, it also keeps mortgage rates artificially low and juices the housing market. In 2006, the Fed owned zero mortgages. Today, the central bank holds around 2.6 trillion in mortgage-backed securities on its balance sheet. So to put that in perspective, about 24% of all outstanding residential mortgages in the US reside in the central bank. That makes the Fed by far the largest savings and loan institution in the world. Think on that for a minute. According to Fed data, the average sales price of a home in the fourth quarter of 2021 was $477,900. That compares to $403,900 in Q4 2020 and $384,600 in the fourth quarter of 2019. In other words, the average sale price increased by $93,300 in just 2 years. That's by far the biggest increase ever recorded in a 24-month period. Now here's a little more data to chew on. The 12-month home sales price increase in the first 3 quarters of 2021 were all above 17%. That's the biggest increase ever recorded over any 3-quarter period since at least 1963. That's the earliest data available. So we have a massive housing bubble, even bigger than the one that popped in 2007 and led to the 2008 financial crisis. What always happens to bubbles? They pop, like balloons at a 2-year-old's birthday party. Regarding rising interest rates, check this out. The Fed has the bubble popping pen in its hand. It's about to raise interest rates. Mortgage rates will go up right along with home prices. Now don't forget, the Fed is already tapering its purchase of mortgage-backed securities. So let's compare the run-up to 2008 and what is actually going on today. The bubble that developed from 2002 to 2007 peaked around a 47% price increase before plummeting by 20% from 2007 to the first quarter of 2009. If we see a similar pattern emerge for the bubble that has been developing since roughly 2012, then we could see housing prices drop by 30 to 40% over a 2-year period. Whatever the final numbers end up being, the evidence is clear. Based on data reported over the past 6 decades, America seems to be on the verge of an epic real estate crash. Not a doomsday sayer here, just saying, check out the data. I don't have a crystal ball, and I may actually be wrong. God, I hope I am. However, if it walks like a duck, well, you get it. Never mind. So that's not to say that we will see another 2008 style crisis, because the dynamics in the subprime market are different this time around. But a collapsing housing market will ripple through the economy, and it's hard to say exactly how it will play out. Regardless, this is a big problem for the Fed because they simply cannot do what they are saying that they're going to do to fight inflation, which is skyrocketing. And this is yet another reason. If it follows through with the rate hikes, and if it stops buying mortgage-backed securities and then starts selling them into the market, mortgage rates are going to skyrocket to the moon. Unaffordable homes will become more unaffordable. Then the housing bubble will pop again. Now, it may not take much of a pinprick to pop the bubble. Even a 1 or a 2% rate hike that the Fed is talking about could actually do it. If you have found this information helpful, don't forget to subscribe, click that bell, and do me a favor, share your thoughts below. Maybe you agree, maybe you don't. I appreciate hearing your feedback. See you next time on Ask the Lender.